All right, our final keynote speaker for this, the Virtual Gold Conference in February, on the day we should have been meeting in person, and I could have had a drink with Mr. Hedley Widdup. He is a fountain of knowledge in the junior resources. Some of you would have heard him speak at our previous events. Really love chatting to Hedley because he basically puts everything into perspective and helps us understand what's going on. And in the case of investment, we really need to keep yourself educated and ahead of the game. So Hedley Widdup, Lion Selection Group, great to see you. Thanks very much for coming on and being our final keynote speaker today when we should have been at Crown Barangaroo in Sydney.
Thanks, Kez. It's really great to see you. And I'm so sorry we won't get to have a drink because it's been a long time between drinks for us, hasn't it? But I'm looking forward to the Zoom tonight, and I will have a drink then. And
that's true.
It's been a good progress through the conference program today. So there's always interesting things to listen to, and today's no different.
Thank you, Hedley. And that's right, ladies and gentlemen, if you haven't already, please make sure that you register for the Zoom networking. Hedley will be there to answer any questions, as will most of our other presenters. Not Rick Rule, because it's the middle of the night for him. But Hedley, let's go ahead. And before you do start, is that gold flecks that I see in that opening slide? I love a bit of gold.
Yeah, it is. So, well, I've been updating the Lion template for presentations, and this comes from the template we use for our corporate presentation. This is the title slide. It used to have a backdrop of a project in Indonesia there, and needed something which was a little bit more relevant to the remaining portfolio. And I actually think this picture's from a piece of core in Mongolia, grading about 25 grams per tonne, and that is visible gold. So you can just see a circular feature. That's my hand lens, which I had close to the core, and I was taking my iPhone picture through it.
And for those of you that go, what's core? Think of it as rock.
Yep. It's a piece that's been drilled out, so it's the best way to tell what's under the ground. So you get a cylindrical piece of rock or chips, depending on the drilling mechanism. In this case, it's a nice stick of core.
Yeah, beautiful. All right, over to you, Hedley.
Thank you. Well, Kerry, thanks for having me, and congratulations on persevering through the COVID lock-ins, lockouts, and everything else that stops us from getting together. But I think this is a fabulous.
And COVID.
Exactly. And yes, and I'm glad to see that you're on the mend there too, mate. So what I always talk about, but I wanted to talk about today is give a bit of a perspective on how we see the mining market at Lion, and I suppose people can generate some ideas from this as to how they feel about what's going to happen next in the world. I won't talk to this slide. I do have a colleague who loves writing disclosures and disclaimers. So, if you download this, please do pay a lot of attention to it, but I'm not going to go through it. So here's just setting the scene. The big index in Australia for miners is the ASX 100 Resources Index, contains BHP, Rio, Evolution, Northern Star. There's a string of others. This is the performance of that index from January 2016 to present. Why did I choose January 2016? That was a turning point. So after a long mining bust, January 2016 was the bottom, and the equity prices of those miners collectively started to go up since then. And they've returned 2.7 times in that time. So if you'd had $1 in January 16, you'd have $2.70 now.
Well, that's quite a good. And can I just ask you that pullback, is that when COVID's first started? That's sort of 2/3 of the way in? Yeah, there.
That's the COVID pullback in 2020. And this is the tech pullback, and this was just late 21. So call it what you want. I don't know why the miners are being sold off on a tech pullback, but clearly these things are contagious, aren't they? So
absolutely.
One thing I think it's important to get a bit of a perspective here. So I'm showing how the big miners have performed. In Australia, we have the Small Resources Index. So the small ordinaries is a component of the larger market. They're still not small stocks. These certainly aren't exploration companies by and large, but the ASX Small Resources Index contains the next chunk of companies down from the ASX 100. So if they're worthy of inclusion in, I think, the ASX 300, but not the 100, you've got that sort of next tier down. And interestingly, if you were to look at these over 20 years, you would see that the juniors, the small resources, typically are slower out of the blocks. And then as you get into a boom, they start to accelerate and probably match the performance of the majors through the boom, but only towards the end. And I think it's an interesting reflection that in this case, rebased to the same point in January 2016, you've got them faster out of the blocks. And the reason for that was there was a spike in the gold price. That index at the time was about half gold companies, half everything else. So it got a real kick along from gold. You've got another period of performance, which was 2017-18, and that was a lithium-induced performance then. So you saw some of the bigger lithium, mostly developers at that stage rather than producers. They're producers now. Were in that index and generated some performance, and then you see it go to a lagging position rather than overperforming, and that was when lithium fell out of bed just before we got into the March 2020 lows, which was the COVID crash. You can see that almost in the middle of the series here, and then I think by far the most fascinating thing about this is that the small resources are now sitting in a position of overperformance. It's actually a 35% difference. So if you'd put $1 in January, you'd get $3. I think it's, hang on, I've got my picture of you there. It rounds off to 3.0, but I think it's 3.04 or something like that times. So you'd actually have more, you've had better performance just being in those juniors. So that's unconventional, and that's driven, I think, very much by the movement towards battery materials. That index at the moment has its best performance of being lithium, nickel, etc. There's been some excellent performance in gold over the time, but it's been overprinted now. So a little bit of a story of where the hot money's going. And just into perspective versus the All Ordinaries, you would have made 50% more on your money in that, but it just shows how clearly the miners have outperformed in that time. So I'm only setting the scene here. I don't think that's going to be news to too many people. Those miners have been quite successful in a share market since 2016. But what drives that, and this is what I pay a great deal of attention to, particularly on circa a quarterly basis. I find it really instructive to update myself on these kinds of things. And I'm talking about liquidity. Liquidity is money moving into the market, and it doesn't move into the whole market in an equal form. So, if someone comes into cash and they think I'm going to invest all of it, it'd probably find its way into Commonwealth Bank and BHP and Woolworths and be across some of those larger things first. Any money which is reinvested is probably going into dividend reinvestment programs. And then some portfolios, quite a few of them, will have a component for risk. And that's what might make its way into exploration stage companies, for example. And you can see how this money moves its way around the market, because it'll motivate things like IPOs, and it will motivate things like exploration fundraisings. And as it makes its way through to embolden the companies which operate in the market, in the mining sector of the market, it'll embolden them to pay for growth, either by takeovers or by building projects and things like those. So I've got a couple of snapshots on how liquidity is performing at the moment. The one that I look at, and I think this is the most instructive, is mining IPOs. And the reason I think this is instructive is that to list a company with no history whatsoever, you're comparing it already to listed companies. So, you buy a listed company or buy the IPO. A listed company has a track record of announcements and things like that. So you can judge where they've come from and where they're going. An IPO has a prospectus, and that's more forward-looking than it is historical, but it's also quite thick and difficult to approach. So to list a new company, you've really got to have a list of buyers which are happy to do that. And it's an instance where you might be selling anywhere between 10 and 50% of the market value of the company in one and asking investors to take it up. Listed companies trade, maybe 5% a day. If they're a liquid company, it might be more, but it's often a lot less. So you've got this huge lump of money that you've got to raise just to get over that bar. So you need to have enough buying in the market to support that. So if you see 1 or 2 IPOs, or you see 100 IPOs, that can be quite instructive, particularly if they're all coming from the same space. And what interests me, I haven't got a chart on this, Kerry, because I think the points are just more interesting to make. In 2020, we saw a large number of mining or exploration IPOs, but in 2021, we saw 4 times more IPOs of exploration companies than we did in 2020. And it was the second largest number of exploration IPOs in a history that goes back, in my data set, at least to 1995. So in well over 25 years, almost 3 decades, second largest number of ASX mining, they're mostly exploration IPOs just on volume.
What are you putting that down to, Hedley? Why were there 4 times more in 21?
Well, in 2021, and this aligns with a number of the other indicators, right? But 2021 was the year that money absolutely flooded back to mining from places like cannabis investment, from certain pockets of tech investment, and from general investment across the market, selling out or, just diversifying, if you like, into risk, which a lot of, I think, funds particularly were. But I suspect that a lot of private investors were as well. And when you see that amount of money which is ready to buy things in the exploration space, then you get a bulge in the number of IPOs coming to market. And so I think the relative is important there. It's gone up by a lot in a year, but the absolute is as well, because when you start setting records for numbers of IPOs, people start to sit up and take notice of it, and it becomes anomalous. So in 2007, there was 143 IPOs. We had, I think it was 105 last year, and the next biggest was 2006, 94. Now, we're aligning, if you like, the number of IPOs. Perhaps it's instructive, perhaps it's not, but with 2006 and 2007 being the last years where you saw sort of volume, they were absolute boom years in mining. They were absolutely flying. So, and it wasn't long after that we had the GFC. Which doesn't mean we've got another GFC coming. It just gives you a relative. We've got liquidity, which is roughly equivalent on this measure to just prior to the GFC, which everybody recognises was incredibly hot for equity markets and for mining companies and explorers in particular. And look, if you extend that to mining companies, I'm making a differentiation here between exploration and mining. A lot of these companies which have listed have been a 5, 10, maybe $15 million raising. So they're not huge listings to clear the market in terms of that money they need to raise. But when you get high levels of exploration IPOs, you sometimes start to see mining companies listing, and they need to raise a lot more money in order to generate a list of listed shareholders or raise the money that they need to clear whatever it is they need the money for. So consequently, you get very, very few listings of actual established miners. It doesn't happen very often in the cycle, and when you do see it, they're large raisings. Now in 2021, we saw the largest mining IPO in Australia for, I think it was 10 years, and the largest mining IPO in Canada for, I think it was 9 years. And they both raised well in excess of hundreds of millions of dollars. So a couple of hundred in one case, and I think it was 700 or so million in the other. So these are large listings, which there would not be that amount of money which is put aside in the market to list a company like that at any other time, except when the market is really quite hot for miners. So I think, this doesn't tell us, I'm not trying to say doom is around the corner. It only brings us to a point in the market where you can say things are very, very hot, and we know where they progress from there. Mining equity issuance is an interesting one, and I'm only going to focus on explorers here because, again, explorers can't fund themselves except when the market is running quite hot. Miners can at most times, and if they want to, miners with their track record can drop their price until the point where they clear a raising. So the largest equity raising of a mining company in probably living memory is Rio Tinto in 2009, and it was an enormous distressed discounted rights issue. So if you use a time series of mining equity issuance, and you look at big companies, you often find that the crappiest years are when they raise the most equity because they can't access funding any other way and their cash flow is destroyed. The explorers are the ones which are diagnostic here because they can only access money when the market is running hot. And we've seen record funding in Canada for explorers. And I'm taking that number from, if you just look at each month, it's called the TMX Market Intelligence Unit, published the raising stats, the volume trading stats, all kinds of things. It's a very interesting document, but the December 2021 numbers showed that funds raised by companies classified as miners, as opposed to cannabis or banking or whatever, on the TSXV, which is the junior market in Canada, have raised more money in that year than any other year on their records, which go right back to 2008. So I don't know, it could have been higher in another year, I suspect not. $6 billion raised by those miners on TSXV, which is a new record. So I think that's an instructive number. I can't tell you what the comparable is in Australia because I don't have them, but I know that Rob Murdoch is going to be presenting.
I know he presented earlier, and pretty interesting how much is going into, especially the gold mining companies at the moment. So if you missed Rob's earlier presentation, we'll make sure that we put it up onto the channel later this week or maybe early next week. But yeah, Rob's Oztex Resources, and he has a plethora of information, doesn't he, Hedley?
He's a font of knowledge, and his data tracking of what's happening with fundings, announcements, and things like that in Australia is second to none. So for a lot of retail or private people who are investing in this space, it is a subscription service, but it is a fantastic source of information. So check them out. But I suspect his numbers probably mirror what's going on in Canada there, from what I can see. And this isn't a signal necessarily of liquidity, but it is a product of liquidity. So mining M&A, which is where mining companies want to buy other mining companies. You think about the evolution of going from bust through to boom and then back again. So if you're in any sort of business which is cyclical like that, when you're in a bust, your cash flows are stuffed. Your shareholders, if you have any, are probably not paying over the odds for the cash flows which you are generating. And you really want to just focus on back to basics, steadying the ship and making sure that your business can keep going on. When you go to the opposite extreme and you're in a boom, all you want to be, perhaps, so maybe I'm exaggerating here, but you want to be as big as you can. You want to be the biggest in the space. You want to show that you're growing. You want to show that you're vibrant. And sometimes the only way to do that is by buying a competitor or a junior in your space. And if we actually make that relevant to now, the past decade or so has seen tremendous underinvestment in exploration and project evaluation in the mining space. So for a lot of the majors and even some of the mid-tiers, their access to growth has to be by some form of M&A, because they often don't have the things coming through their own pipelines. Now, it might be a bit unfair of me to say that, because if you look at any company, they probably do have something which is next off the blocks, but there might be better things which they'd prefer to invest in, or there might be more than that that they need to invest in order to build their company into what it is that they want to appear to be. And I certainly get the sense from talking to investment bankers and colleagues in the space that there are a number of even major scale companies who would like, within the space of probably 18 to 24 months, to look like something that they're not at the moment. And by that, I mean more significant in battery materials, more significant in the spaces that they're already involved in. And that period of time is not something that you can generate through organic growth. That needs to be brought in. So I can see transactions that could be conceived from this. They would have to be large if that's the case. And just that, I suppose that's an analysis off the top of my head of the majors, and could turn out to be wrong. But there are plenty of rumours which abound, so I'm probably not the only person who's thinking this, and rumours typically don't come from nowhere. But in the exploration space, this is the stage in the market where smaller companies which have interesting looking projects, sometimes even well-defined projects which are getting quite large, can become strategic, and they start to become the subject of hostile inquiry from bigger companies who feel that they either want to get their foot on the ground so that they can control that part of a belt, or they feel that the future production to come from these juniors is going to be significant in terms of their pipeline of things. Typically, you don't see a great deal of M&A, particularly of large-scale M&A, which is directed towards exploration and junior miners, except through sort of mergers of equals and things like that as time goes on. But in the peaks of the boom, you can see larger deals, and I think we can see the signals that these are coming through anyway. So
the famous clock.
To pull liquidity together, we track all of these indicators: IPOs, behaviour around M&A, the size of raisings, the state of exploration, and how much of that is going on. There's a number of things that go into the judgment here, and then we talk about that as a clock. So it's 12 midnight when the mining cycle crashes, and that could align, or it typically has aligned with equity market collapses in the past, but there's been examples where it's been a mining specific crash as well. And then the boom restarts at 6 and it gets quite hot and exciting. So the peak of the boom, if you like, is 11:59. Now, our judgment here is that liquidity, as I've just explained, is at a very high level. I don't think anyone would dispute that the equity market is quite hot at the moment. In fact, that's quite non-controversial. What happens next is the controversial thing. And I don't want anyone to think that by saying it's 11 o'clock, that I'm forecasting that tomorrow or the next day is going to be a market crash or a mining collapse. What we know from history is that mining cycles, amongst equity market cycles, never go on forever. So at some stage in the future, there is going to be a collapse and a correction. And we know that's coming. We just don't know when it is. And we know that in the lead up to those, we've seen this constant evolution towards the kind of liquidity signals that we're seeing now. So it's not a
Hedley,
time thing. Yep, go on.
Hedley, I'm really interested in this, the way you're saying that things move in cycles. And I do agree with you. But we live in interesting times, Hedley, and you actually mentioned ESG and battery. And I know this is a virtual gold conference, but there is a lot of money being printed, and there is a lot of movement from, I guess, the internal combustion engine to the electric vehicles. This is all going to take a lot more, a lot more of our resources, number one. Number two, we're getting inflation. We're getting talk of war. So the safe haven of gold and the increase in the need for gold is there as well. So my question to you is this time different? In other words, will the cycle extend for a lot longer because we are in a massive change, almost an evolutionary change, given what's going on?
I think, well, and that is precisely my point, Kerry. These elevated, call them investment conditions for miners, and miners sit within the broader equity market, right? So I think there's a huge amount of transmission from the excitement which is taking place within the equity market. Tech stocks, you name it, everything is valued fairly richly at the moment, and that transmits itself to mining as a microcosm of that. But you're dead right on the fundamentals of mining. Why couldn't this go on longer? And I've got a couple of thoughts on that, and I will probably elaborate on these as we go. But cast your mind back, and some of the people listening to this might not remember so far back or have been active at the time, but 2006 and even 2007, and dare I say it, 2008, there was plenty of people calling in the market, it's different this time for mining because of China. And China was the main reason at the time. Now, the evolution of the mining collapse, which occurred alongside the GFC, some of the worst of the developments in the financial markets happened in 2007, late 2007, even early 2008. And the mining market didn't largely collapse until just after the completion of the Beijing Olympics. And there'd been this, we're switching off industry in China so that we can have clean air for the Olympics, and then we'll switch it back on afterwards. And that was very slow to take place. And it was when the notion set in that, okay, the commodities market is not going to continue going all by itself, and it collapsed. So, you know, this financial transmissivity of risk and issues when the risk starts to unravel made its way through. So it was different up until the point when it wasn't, and everything collapsed at that point. So I think there's a great example of when something comes home to roost, it finds its way into the mining market, even with strong fundamentals. Now, China did not go away, and come the recovery of the rest of the world, and we had this enormous switch on of stimulus and quantitative easing and other things, which took us into 2010 and 11. And 2011 was probably a far more liquid year for miners than even 2007 was. But 2011 was the real turning point in sentiment for mining, because I think the amount of money which has found its way in there had just pushed exuberance to a level that the market couldn't tolerate anymore. And there was a fundamental shift in sentiment where miners became bad news come 2011. And 2012, 13, 14, 15, there was a collapse in commodities and valuations. So I think there's an example there of how the market can crash mining, GFC, and miners can crash mining, a la 2011 to 2015. So what will happen this time, I don't know. But that's why telling people the market is hot now is non-controversial. Talking about what will happen is controversial. And I suffer badly from confirmation bias. So I think it's best that, for me, I can tell you that I think that we're in a hot market. So investing aggressively now is a dangerous thing to do. But if you're a trader, you can probably still make some fantastic returns off of the things which are only possible in a hot market. I'm not a trader, so my perspective is based more on the sort of what will happen in the next 12 months, 24 months, rather than what's going to happen in the next couple of days. And I've constructed, I suppose, a couple of dot points and then some charts to follow on the bull case and the bear case of what happens from here, bearing in mind that we're 11 o'clock now, and we know that these things can play out, you know, as the positive fundamentals come to bear, and then the negatives can overprint that as well. So you made a couple of points before. You finished it up with, is it this different this time? But I was hearing that question all the way through your points there. And surely it is. I mean, it was different this time with China, right up until the point where a global financial catastrophe took place. And it's different this time, I think, from the perspective of the intersection of, we're in a shortage of everything scenario at the moment as far as a lot of supply chains go. That leads to inflation. It leads to demand pricing of commodities. And we're in a position of, I think, rebounding global growth off the back of COVID. COVID hasn't gone away, and we don't know how that's going to go away, but I think we're seeing stimulus, perched savings, all kinds of other things moving in a way which is very supportive of commodities. And in specifically the gold space, if inflation bites, that tends to be very supportive of hard assets like commodities. We've also got this first time ever, I think you could say, a going green battery material demand. More and more things becoming battery materials. Some of them are questionable, but if you can brand it as such, then it's successful, at least from a promotion point of view. But the genuine ones, nickel, lithium, etc., have had wonderful performances over the past 12 months, having come out of that COVID crash in 2020, and they've been re-rated very, very strongly, which shows you that demand is there. And how long will that go on? I mean, you read some of the fundamentals on the research for things like lithium, and there is no end in sight. But we know that with all commodities, sooner or later, supply catches up, and that can reprice the equation, and sometimes quite quickly, depending on the sizes of those markets. And I will show in the bull case just a comparison of the valuation of equities versus the valuation of commodities. And I'm talking about general equities versus general commodities. And at the moment on that measure, commodities are very, very cheap. So these are all the arguments which run very much in favour of the bull case to say, from a mining perspective particularly, there is an outlook which is strong. I think what you've got to align that with, you've just got to second guess your own opinions all the time. You can't, like I sometimes fall into the trap of thinking that you're right and then behaving like you are. With all cycles, and mining is tremendously cyclic, always has been, and I think it always will. The music always stops, and it's usually by surprise when it does happen. In retrospect, it was quite predictable, but when it happens, it will come as a surprise. And that's not to say that we can't see the indicators now. Perhaps we just don't interpret them in the way that they'll play out. We're in a superheated equity market. Now, the more superheated something gets, the more potential for collapse there is. I'm not trying to be a party pooper here, but that tends to be the way that the equity markets have played out over hundreds of years. So I wouldn't think that that changes too much just because we're in a market with people wanting to go green and have ESG credentials that overprint everything. And look, from particularly the point of view of where we invest at Lion, and I think where a lot of your clients invest, Kez, is that if there is an event which takes liquidity out of the market, it'll damage your BHPs and your Rios for a period of time, and their price will come down, and then they'll start going back up again. But from the point of view of explorers, their ability to raise money will stop at that point, and there will be a period of time, probably years, where it's difficult for them. So when you see and let's call it an equity market collapse, if that's what the event is, or an equity market softening, I think there's so much liquidity in the market now that an event of that size will start to make the risk investors second guess it and retreat to something else for a period of time, and then only slowly trickle back to the places where they've been nicely inflated. So it's in the exploration part of the market where I see the biggest risk on valuations as you go through an event like that. And as I said, we know they come, we just don't know when it'll be. And overprinting that, and I see arguments on both sides here, inflation is what everybody is talking about in the market at the moment. Well, if they're not talking about Prince Andrew or COVID or Taiwan or Ukraine or Russia or what the US will do about any of that. Inflation is a clear and present danger there, and it's a double-edged sword. So if you're a gold investor, you're probably sitting there wetting your pants about what inflation is going to mean, because historically, inflation appears and then it bites, and there's sometimes a fair period of time between the two, but when it does, gold goes on a bit of a rocket ship run. Yeah. So from a gold perspective, that's a bull case argument. You flip that on its head, and when inflation bites, and this is probably a scenario that we don't have much experience with or precedent for in the global market, inflation prices the cost of capital. So at the moment, the risk-free rate is very, very close to zero, which means that equities can trade at enormous valuations. And what I mean by that is that you spend an awful lot on a share for the underlying earnings, and sometimes when there's no earnings at all. And in tougher parts of the market, when interest rates have been higher, classically, earnings have been sort of bought at prices which are, well, I'd say far more reasonable, but cheaper. So you pay a lot less for the underlying earnings. So I suppose if you look at it that way, if inflation goes up, interest rates will probably have to follow at some stage, or should follow. And the price of equities will come down to reflect that, because you can get a risk-free return by investing in bonds then. And a lot of the money which has been chasing returns has had to come to equities as the only place. So I can see inflation being a double-edged sword there. Great for gold investors, might not be great for equities. And what happens there? Well, I suppose we'll only know once.
1 minute lleft, Hedley. I'll give you 2 minutes, but we're running out of time, and I know there's lots to do.
I've talked too much. So here's the bear case on inflation. It's inflation in terms of CPI versus bond yields historically. And there's not a straight line, but inflation in 2021 was at levels which would have been commensurate with much higher interest rates in the past. I'll leave you to think through what will happen there. Commodities versus equities. This is the S&P 500 versus a basket of commodities. So what that line says at the moment is commodities are extremely cheap versus global equities. They were just before the tech wreck as well. So perhaps equities have been inflated by tech. I don't know the answer to that, but I don't think this means that commodities need to rush up to meet it. It could mean that equities come back down, and that would reset this to closer to the global average. But that's a bull case. The valuation of miners. Now, this one should take a little bit longer to explain, but I'll give you the quick version. The amount of EV, enterprise value, that you have to spend to access the earnings of a company, the EBITDA, and I've picked on the 3 companies which have been consistently in the ASX 100 for 20 years or more to do this. In previous cycles, the market has paid far more, I think, on average, for things like BHP and Rio's earnings and Newcrest than they do now. Now, by the time you average everything out, you take some lumpy numbers, and you might have to squint to see that. But I think it is fair to say that the market is paying less for the miners at the moment. And I'll come back to that because I've got a couple more slides which will support it. I won't talk about gold equities at the moment. I'd rather talk about this one, which is the miners in Australia. This is a chart from 2002 to 2022, are on record high yields. So they're paying larger dividends in a proportion to their market cap than they ever have before. Typically, miners' yields have only gone up through busts. And here we are, they're going up through a boom. And I think that is probably sentimental that people are still not re-embraced miners as being good corporate citizens yet after having a period of moving away from them. And there's been good reasons. If you blow up someone else's cave, it's not good for your ESG credentials. But here we sit on a record high yield. And if you line that up against what the market is paying for earnings, I think that says that the market could afford to pay a lot more for miners. So that's another bull case argument. And the materials sector in Australia is trading at the top of its historic dividend yield trend, 20 plus years, I think that was. Everything else in the Australian market is trading very close to its the bottom end of its yield range. So miners really do stand out on that. So, Kez, I've rushed through the last few slides there.
Yeah, you had to, my friend. You had to. We've run out of time, but I want to really, really quickly just ask you. Lion Selection Group just did a transaction with something you had in Indonesia. So, ladies and gentlemen out there, if you think Indonesia is not a place to go, trust me, these guys have just done. Talk us very quickly through, because I want to know for Lion, because you are an ASX listed company, you've done a deal which I think is worth about $52 million US, where you have divested of an asset in Indonesia. Just quickly give us the highlights. Will there be dividends for shareholders?
Yeah, sure. So Lion has been invested or exposed to this project for quite some time, slightly over a decade. We'd worked ourselves into a position where this joint venture, which is over a marvellous gold project in Indonesia, we had, that was about 65% of Lion's underlying value. Now that's been transformed more or less into cash. So in 12 months' time, Lion will have gone from being 65% Indonesian gold JV to about 90% cash. So wonderful outcome. And that closely aligns, I think, with what I said before about projects becoming strategic and the best time to sell them being as you're getting into a heated cycle. What it means for Lion shareholders is that at the moment, particularly as the realisation of this washes through the market, you can buy Lion shares for about 50, 52 cents, and they're going to be cash backed to the tune of about 65, 70 cents. So that's not a bad metric. But you asked about dividends and distributions, and historically, Lion has always returned a portion of its windfalls to shareholders. And at the moment, we're working through what the tax situation is so that we understand franking. But I think you could say that the perception or the sentiment of the Lion board and the Lion team here is that, particularly because we own about 22% of the company, it'd be great to see some of that go into pockets.
Absolutely. Well, Hedley Widdup, we'll see you. I'm sure there'll be some questions about that at the Zoom networking in about an hour's time. So, ladies and gentlemen, we'll see you there. In the meantime, Hedley, thanks for chatting to us at Virtual Gold today. We'll see you in an hour.
No worries. See you then, Kes. It's been great to talk to you.
Cheers, mate.